Now, I've only got 10 minutes today. That's all they'll let me have, so bear with me. My name is Mark Taylor. I'm the Chief Customer Officer for Selftrade at Equiniti, and as James said, we touch the lives of over 27 million people in the UK, whether it's paying the armed forces pensions, looking out at Selftrade, which is an execution share trading platform, or indeed, we're the largest registrar in the country looking after the interests of over 60% of the FTSE 100, and we're probably the biggest share plan administrator in the UK. So one way or another, we might well touch your life in here today. But what I wanted to try and spend the next 10 minutes looking at is volatility in the marketplace, and then to tell you a couple of stories of observations. My job these days is to look at how customers do things, how they think about things, how they interact. And sure, you can do lots of technical research and analysis in the marketplace. You can talk to lots of people. But at the end of the day, you're human. And therefore, you interact differently to the institutions, the pensions, etc. And I'm in a really privileged position because I get to watch what's going on and talk to customers and find out what they're thinking. But having been in the markets myself for probably the best part of 30 years or so, and apologies on this one at the back, you probably can't see this, I'm fascinated when we look towards things like volatility. And we haven't really had that much volatility in the market for probably the best part of 2 years. I look at an index called the VIX index over in the States, and it's a great indicator of volatility. And when I talk about volatility, it's about how much the market is going up and down in any one day. And probably for the last 2 years, it hasn't been doing a great deal. It's been bumping along at around about 10, sort of on the lower end of the scale. The historic average for VIX is around about 20. So 10 over the last couple of years or so is actually very low. But look at what happened round about February. It went nuts. For comparison of what it had been doing, and we started to see volatility return to the marketplace. And look at what happened to the index over. I plotted it against the all-share. The index was going in the opposite direction. Now, volatility is not a bad thing. You need it every now and then to give the market a bit of a kickstart. It makes differences in prices. And that's really what I want to focus on today in terms of looking at that volatility and what people think, and a couple of stories to go alongside it. So the things I'd be saying at the moment would be, don't let this wave of stock market volatility go to your head. The value of the companies in your portfolio doesn't change by a positive or negative 5% 3 times a day, unless you've got a very interesting stock. If you choose companies and get the value right, then the price will follow. And that's the key message I want to try and put across over the next few minutes. So I was talking with a prospective customer for Selftrade the other day, and he was a physicist, and he'd made thousands of pounds by owning rental properties. He confessed, though, he was never able to make much money in stocks. And I guess there are a bunch of people here today looking at property and all sorts of things, but some have never been really successful about stock market investment. And as I talked to him, I observed why. On that particular day, the FTSE was having one of those 50 points up, 50 points down days, and he was visibly happier when the market was going up, but sadder when it was going down. And my observation was that people who are otherwise successful businessmen and investors in private businesses or property change their behaviour completely when they start to enter the stock market. And I think if I look at that, I've got a friend who actually, his father has started off a number of companies in Europe. He's built them. He's done very well for himself. He is an absolutely brilliant businessman. But he's the worst stock market investor I've ever come across. He'd fret about every move in his stock. He'd keep watching it. And often, it's about our attitude towards judging risk. So if you look at what's happened in this volatile period, there's actually a bit of a sale going on. If you look at what the FTSE has done since the beginning of the year, it's probably off about 5 or 6%. But people don't necessarily see that as an opportunity. They actually start to fret about it. And as I talked to that physicist, I used his analogy. And If I look at risk and what we do, we did a bit of a poll. So we asked the market, the customers that we've got at Selftrade, market's fallen by 5% since the start of the year. Do you see it as a buying opportunity? And there are a few people out there that do. But look at the number of people that are saying it's making me nervous. I'll sell and cut my losses, or none of the above. And then we said to them, which of the following behaviours would you consider risky? Now, somewhere in here I said using a knife to get a bit of toast out the toaster. And okay, that's good. So most of you think that's a fairly risky thing to do. But not wearing a seatbelt comes out as risky. Cycling without a helmet, certainly in London, that's quite important. But there are still people that consider investing in the stock market as risky. And it is. You can still lose money in the stock market, but it's a question of doing a little bit of basic stuff to ensure that you don't. And I'll go on to that in a minute. But back to my physicist friend. Great brain. And if you think about the brain, it's an interesting thing. Most of the stuff that goes on up here is logic. Most of the stuff that goes on behind here is emotion. And it's emotion that typically drives the stock market. Fear and the desire not to be out of the market but in the market, or fear that things are going up and you're not there, etc. So there's all sorts of things going on emotionally, and yet we try and apply the logic side of things, and it doesn't always work. So what we, or any rational investor, does is not much different from buying a property. So if I look at property, you look at the quality of a property. How well the building is built, the location, the demographic trends, the area, and so on. And then you start valuing that property. You formulate your best case scenario and the worst case scenario for rents, occupancy, property taxes, and other important variables. You then start to think about price to square foot, price per bedroom, price to worst case, etc. It's no different in the stock market. The things to look out in those short-term or shortcuts in the stock market are price to earnings ratios, price to cash flow, and price to book value. Those are the three things to really pay attention to when you're looking at stocks. Now, think about the stock market. If the price of the property is at or below your worst case scenario, you buy the property. If not, you move on. And that's rational. It's that frontal lobe going again. It's a business-like way of valuing a building or any asset, including a publicly traded one. Yet there are two important differences between a building and a publicly traded company. It's about getting the value right, and then the price will follow. The stock market offers instant liquidity and low transaction costs. These differences should be huge advantages to you. To sell a building, if you've done it before, you know that it's going to look at big transaction costs. 3 to 7% of the building's value to buy and sell, in and out. You might well spend 6 to 14% of the entire property just in costs. And yet the stock market should be a paradise for a property investor or a businessman. Instead of having to deal with tenants, you buy stocks, or even a property REIT. You'll see a few of those here today, which is a real estate investment trust, and that owns hundreds of properties. The REIT is run by a professional manager. In this case, the definition of professional is they get it right, and they take away the hassle. You can let them deal with tenants. Of course, you don't have to analyse the REIT's management to make sure that they are competent, because that's what they should be doing. But the analysis is not much different from what a business person would do when hiring a manager for a building. So you can do the same analysis. You performed on an individual building or on a REIT. And here is where we enter into the domain of the stock market. The rational person is replaced by an irrational one. Stocks are priced every second of the trading day. Thousands of times a day, someone tells you, this company is worth this much. Actually, this is not what they're telling you. This is what they want you to hear. What they tell you is, I would buy or sell this company for this much at this moment in time. So when you're looking at your screens and you see that price that's quoted, that's what the market will give you at that point in time. There are a million reasons why someone might want to buy or sell a stock on any given day. You don't necessarily know if a tracker fund is trying to build a position in a stock. And we'll probably see that happen in the next few months with the recent example of Unilever declaring they're going to end their listing in the UK marketplace. Think of all the tracker funds that are holding Unilever. They've got to sell down their position, potentially. That's going to affect the stock price. But you don't know when they're going to do that. They'll do that over a period of time and gradually move out from the market. So as a private individual, you can't really judge truly what's going on in the market because there are all sorts of things going on out there. Many of those movements in the price from one day to the next have nothing to do with the company's value. So yes, there is a difference between value price. You only know the difference if you've spent time to value the company. And therefore, it's about fundamental research. If your building was a public stock, its price would fluctuate daily. And most of the fluctuations would just be noise. The price would be moved based upon local weather, employment, traffic. The list is long. A lot of these factors will be transient and random in nature. In a word, noise. If a building similar to yours is put on the market at a ridiculously low price by a false seller, you're not going to be upset that your building is now probably worthless. You'll see it as an opportunity to buy another building on the cheap. That's rational, business-like behaviour. Often what we forget is that cash isn't as good as the stock market over time. There are going to be years occasionally when cash beats the stock market, but on the whole, rationally, we know that the stock market over time builds value. And the liquidity of the stock market and its negligible transaction costs are a great feature, but probably do most people more harm than good. They can turn even the most astute private investors into degenerate gamblers on a daily basis. The difference between a gambler and a degenerate gambler is the degenerate gambler puts everything on the line. When you gamble in the stock market with all your life savings, you are then a degenerate gambler. And that's why it's important to focus on what a business is worth and how the market prices them. Thank you very much for your time and attention. Hopefully that's useful. If you want to stop by stand 63 today at Selftrade, the Selftrade team will be there. We've got 5 top tips which we've recorded for you. Do pick up one of those. And the team, myself, will be there. We'd love to hear from you. Thank you for your time.